Hey guys, John Paulamy here, Actionable Intelligence. Today's Saturday, November 10th, 2018, and we've got the weekly market update. So first things first, just want to talk a little uranium. Kind of like John Quakes when he puts up his chart up there that shows the percentage increase from the April lows. It's now 43. We're up 43% in physical uranium since the lows in April. So that's looking pretty good, guys. And I want to speak to that real quick. You know, I spent a lot of time on Twitter trying to build out the brand, connect with a lot of great people, a lot of smart people. There's a lot of what I would call novices or naive people coming into the uranium space. And I see a lot of this consternation and hand-wringing about what juniors I should buy, or, you know, the status of this XYZ or ABC company. Guys, let's talk about this realistically, okay? There's this idea, you know, everybody wants that 10,000 or 10,000% increase junior. It's not that easy, guys. I've said this before, I'll say it again. There's nothing wrong with buying physical uranium at basically these giveaway prices. This current uranium price in the spot market is like 50 to 60% below what just the break-even price is for many of these mines. Okay, so there's nothing wrong with a 43% return in about 6 or 7 months. Like I've said before, you've got billionaire professional investors. You got most of us, including myself and you guys out there, couldn't carry their bags for them to get on an airplane. Okay, and these guys average about, Warren Buffett, 20% a year for every year for the last 30 years. That's, you know, annualized. That's not every year. Obviously, they do have down years. Or a Prem Watsa in Canada, who's averaging 18% a year. And then we've got a 43% gain in this basically uranium space, and everybody's, you know, lamenting about you know, when are these uranium juniors going to start moving? They ain't going anywhere for a couple years, guys. More than likely. This price is going to keep creeping up until we see the catalyst, which I saw a guy on Twitter say this the other day, and he's right, and I've mentioned this before too, until we start seeing the long-term prices, contracts by these utilities getting signed at 50, 60, something like that, okay? Then you're going to start seeing some movement. Until then, you're going to keep seeing this. You know, and it gets a little bit boring for me, actually, and I don't want to criticize anybody, but, you know, announcing every 5-cent increase in the spot price. I like how John just puts this chart up every week. It kind of keeps things in perspective. You know, we've got a 43% return in the physical uranium since April, and everybody's crying poor. I mean, I think this is terrific. I've been advocating this. I advocated buying Cameco as the cornerstone for your uranium portfolio. But you know, it's only going to probably go up 5 times during this uranium bull market. It's not going to, you know, but I'm not going to, you know, the risk is substantially lower. So let's keep things in perspective. This is still a bargain. If you're new to this market, there's nothing wrong with just buying physical uranium and buying Cameco. You'll sleep well at night and you'll make a tremendous amount of money. You'll far exceed what the market's going to do. Guys, we have a rising interest rate environment in the U.S. We are going to have a recession here. I don't know when, but sooner rather than later. And we are going to have a big drawdown in the stock market. A lot of these uranium stocks are going to go down. We saw that in this pullback we had in early October, or over the month of October. Even the price of uranium participation, which is spot uranium, went down, even though the price of physical uranium went up. That's a buying opportunity. So, you know, I'm not going to, you know, a lot of this is mental masturbation by a lot of people that are not thinking long term. I mean, we got the holiday season coming up. Watch, you know, hey, you got Turkey Day coming up. Spend time with friends and family. We got college bowl games coming up. We've got Christmas and New Year's. Nothing's going to change dramatically. Take a chill, sit back, have a few drinks, enjoy your family. The uranium price will take care of itself. Okay, enough said on that. Now, what I really wanted to talk about this week was what has happened to the oil price. I mean, look at that chart on the right there, guys. I mean, it's complete devastation, annihilation of the oil price. And it's kind of surprising me. So I spent a lot of time in the last couple weeks really studying what's going on. I've talked to quite a few people. I've read some folks that I respect, some of their input. I kind of had this, you know, kind of in my mind. But, you know, we've got to make sure, is this a telltale, this price decrease? Is it telling us that worldwide economic growth is coming down, therefore oil demand is going to go down, and therefore that this is a leading indicator? I'm not so sure. I think there's some other things going on here that led to this tremendous liquidation that we've seen. That's not typical. So, for example, I mean, oil was down over the last 2 weeks, 10 days in a row. That's never happened before. I mean, you don't even have a relief rally there. And part of that has to do with, and I'll get into it later, the futures market, the financial part of the paper oil, if you will, and the fact that we have a lot of algorithms and computers running things. So when things are going up, these algorithms are all trend following. So as soon as things turn, everything is liquidated on the long side and short positions are put on. So all these moves, this volatility is exacerbated. We've talked about that before in the gold market, in the uranium market, in all these commodity markets, in the stock market. Volatility is going to be exacerbated by program trading and algorithms. So if you can't stomach it, you need to get out, because you're going to see more of this. And what works to the downside also works to the upside. So what I wanted to say is, like, has the oil market fundamentals really changed in just a few weeks? I mean, 2 months ago, everybody was talking about $100 barrel oil and undersupply, and now we're talking about worldwide recessions and oversupply. And you got people on CNBC who are never right, i.e. Jim Cramer and some of these other morons, talking about $40, $30 oil. I mean, I guess it's possible. Anything's possible, but what are the real fundamentals? Let's get into it. One thing I do want to say is, even from a technical basis, I mean, oil's extremely oversold. Now, I don't know when it's going to flush out. I don't know when the final liquidation, all the people that want to sell have sold. I'm not sure when that is, but I think we're pretty close. I mean, that's, talk about, stair step up and then an elevator down. That's the definition. But I want to get into some of the what I've learned over the last few weeks. So we've had many events that I think that have really contributed and all came together at the same time to really exacerbate this move. The fall time, we coming out of the summer driving season. It's typical that oil demand does decrease in North America and in Europe. Vacations are over. It gets colder. People spend more time inside. This is just pretty typical. Another thing, refinery turnarounds cause refinery runs. What we're talking about refinery runs is the amount of barrels that they're putting through of crude oil and turning it into product. Are down you're down 1.2 million barrels a day versus a typical 700,000 barrels a day. So what we're saying is typically during the turnaround season, when the refinery shut down for maintenance, it's usually a 3, 4, 5 week period, 6 week period. They have to transition to different blends of gasoline or product that they're making, or they need to, or the units in the refinery require certain maintenances that need to happen, replacements of parts and equipment, whatever. That happens every year, and obviously, if the refinery is not processing crude runs, there's not going to be as high as a demand for oil, and that's typically 700,000 barrels a day during that time. This year, it was running about 1.2 million. Now that we're getting near the end of November, a lot of the refinery turnarounds are ending, so we should see that reverse. We should see demand go back up as they start pulling in crude to make product. As we talked about earlier, or I just mentioned briefly, the net speculative oil futures contracts were liquidated at one of the largest rates ever seen. And like I said, that was a direct reflection of the new normal, which is going to be trend following by algorithms and computers, so that once a trend gets put into place, whether it's on the long side or the short side, you can expect the computers to come in and really drive it and really exacerbate the volatility. This is the important thing here that I think that I want to spend some time on is Russia, and I have some charts that are going to visually help us on this. Russia and Saudi Arabia increased production in anticipation of the Iran sanctions. Deal made to hold oil price down through U.S. midterms? ? Yes. Saudi Arabia and Iran are mortal enemies. You have the Sunni Saudi Arabians with their brand of radical Wahhabism. You have in Iran the Shiites. They're mortal enemies. That's they're conducting proxy wars all over the Middle East, i.e. Syria, i.e. Yemen. Most people in the United States can't even find these places on the map, don't know the different parts of Islam. I'm not going to get into it. What I am going to say is that Donald Trump and his administration and some of the actors in the administration were not happy with the Iran deal that was made during the Obama administration, and were very vocal on saying they were going to reverse it and throw massive sanctions on the Iranians. I believe that, it was not, I mentioned this in a previous video, I actually didn't think Donald Trump was as stupid, so we did see probably a deal get cut with the Saudis, which are great allies of the U.S., whether I don't agree with it, but that's the way it is, to say, hey, can we turn the taps on so we can compensate for the sanctions that we're going to put on Iran so we don't see this big run-up in gasoline pump prices right before the midterm elections. I mean, the last thing that the Republicans needed going into the midterm elections last week was, pump prices at $3.50 a gallon for gasoline or $4 a gallon for gasoline. We didn't need that. And I was kind of, wondering what they were going to do. So we have to remember something. All these people are not good people. Okay, that includes the United States government. I'm sorry if that offends people. I don't really care. Unsubscribe if you don't like it. You're dealing with sociopaths. You're dealing with people that are trying to exacerbate their power for whatever reason and find advantage. So the Saudis, being allies, they were happy that we were putting sanctions on their mortal enemy. So they're happy to increase production in the short term to help Donald Trump and the Republicans take away one of the possible negative aspects going into the recent midterm elections. Now, Russia goes along for the ride. Russia is one of the largest oil producers in the world, either second or third. And, Vladimir Putin's going to do whatever he has to do, and the Russians, to maximize the return on their oil assets. Plus, this is to their advantage to go along with this. You build up chits and chips with the Trump administration, helping us out. Do me a solid, if you will. So I think what happened was, and we've seen this recently in the news, is that, okay, you have to balance all these things out. Okay, so we're going to take a million and a half barrels a day of Iranian crude off the market through these sanctions. Well, as soon as we do that, I mean, most of that crude doesn't come to the U.S. It goes to places like China, Japan, South Korea. These, Japan, South Korea, some of these places in Europe, these are our allies. So they started bitching to the Trump administration, hey, wait a minute. You're pulling this crude out from Iran, and we are buyers of that, and we are all oil importers. Hey, what are you doing? This is not a good deal. So you saw the recent concessions. I believe concessions have been granted now to maybe 7 or 8 different countries to allow them to import crude. India was another one. And, so I think what has happened is that you had some of the OPEC countries like Saudi, Iraq, the UAE, and then the Russians increased production in anticipation of replacing the crude oil that was going to be sanctioned and not exported by the Iranians. And then I think the Trump administration kind of turned around and double clutched some folks when some of the allies started crabbing about, hey, what about us? So I think you're in a position now where you're kind of overproducing oil, and that didn't help the situation. So you really have to take these political machinations and these little behind the closed door deals and factor them in. Now, that's not the only thing that happened, but it's one of the things, and it's very important. And I think what you're seeing already in the news, which I've seen in the last week, is already talk about by OPEC and by the Russians about maybe we need to cut back on production. So you're already seeing this reversal. I think the Saudis may have got double clutched here a little bit. They really raised production to help out the U.S. administration, and now maybe they got into slight overproduction. I have seen some data from one of the guys that I follow on Seeking Alpha, and they're already starting to show imports of Saudi crude in the U.S. are already in decline. So we may already see the reversal, if you will. Now that we're past the midterm election, we can go back to maximizing our potential. Because you have to understand something. This Sheikh there, this 30-year-old guy, 34-year-old guy over there in Saudi, I mean, he's trying to transform his country. It's not to his benefit or to the Russians' benefit to have $40 oil again. So I'm not suggesting we're going to go to $100 a barrel, but I'm not sure that they want to see $60 a barrel either. So we have to keep an eye on that. We have to keep an eye on what is coming out of OPEC and what people are saying and what they're planning to do. So I think that's a big part of this recent down draft, and I think that we should be looking for a reversal in some of those actions to strengthen the oil price. Another thing I think is that, I mean, I have to admit it, I don't know how much further this can go, but U.S. oil production has made another new high. We are now the world's largest oil producer, the United States. Tremendous amounts of production coming out of the Permian. And it's just, I think, really surprised some folks to the upside. How much higher can it go, though? As I discussed in the last few weeks, you know, a lot of the parent wells or the first generation wells have already been, the cream of the crop, the low-hanging fruit, if you will, has been plucked. Now we're getting into the child wells, the second tier wells that are not as productive or as efficient. So we still have this, you know, view, I think, with a lot of the companies that are operating, oil companies, because of what happened during the last downdraft in oil, that there's going to be a lot more consideration giving to just, you know, opening up the investment checkbook and sanctioning new projects. However, I mean, we are still seeing drilling rigs increase in the Permian. So, I mean, I guess these people never learn. If you're an oil company executive and you're operating in these places, a lot of times you don't own a lot of shares in the company, or your incentives are different than the shareholders, and you're probably being told, you know, or maybe your compensation's being determined by how many wells you drill or production increases or something like that, not maximizing return on investment and return on equity. So we have to watch that. I mean, how much further, how much more production? I mean, the further this goes on, because of the decline rates and the amount of wells, at some point you get into a Red Queen race where, you know, if your production goes up to 11 million or 12 million barrels a day, and you're in these huge decline rates in the first year where you're losing 20 or 30% production, I mean, just to stay even, you have to drill more and more wells, not even mentioning how many more wells you'd have to drill just to get increased production. So, but I have to say the U.S. shale industry has surprised everyone, and so that's kind of an unknown. We don't know what's going to happen there. This is a chart that we were talking about financial oil demand. Here we are talking about net long positions in the New York Mercantile Exchange and the International Commodity Exchange managed money long positions. And these are contracts for West Texas Intermediate crude. And you can see from last year, or mid 2017 to 2018, look at that liquidation, especially that waterfall drop on the far right. We've never seen anything like that before. That's really that's what I talk about when I'm talking about the computers and the algorithms, and how any moves either to the upside or downside are going to be exacerbated by you know, the AI and the computers. So once there's a trend change, they jump on it. They are programmed to do that, and that's what they do, and that's why I think you've seen increased volatility, and you will continue to see increased volatility. It's not going to go away. I think, though, that if you are wise and you really understand these markets, then you say to yourself, what has fundamentally changed, or is this just a confluence of events and an exacerbation of the move by financial actors in the market? I think that's probably what has happened. This is a chart that shows, this kind of goes back to what I was talking about, the backdoor deal, the Trump administration with the Saudis. This is the production change from last May, when the sanctions were being contemplated, you know, to now. You can see, you know, if you total up, you know, look at Saudi, over 750,000 barrels a day increase, Russia, UAE, Iraq, you know, they all got the memo. We need you guys to pump more, to alleviate, so that when we put these sanctions on and remove the uranium barrels, we have something to replace them with, so we don't get an oil price spike and then tank the midterm election. That's basically what happened here. I mean, the data's there, guys. I think what's interesting, I'm going to show you in the next chart, though, is that something very interesting. In order to do that, in order to replace the Iranian sanctioned oil, basically a lot of these countries had to hit their maximum production limits. Look at Russia pumping at 100%, UAE at 100%, Saudi at 100%, Iraq at 100%. So there's no spare capacity. This little game that was played was fine, but we are now in a situation where, you know, 100 million barrels a day in demand, and you've got all the major oil producers pumping at 100%. So if you have any type of supply disruption, I mean, Libya could blow up at any time, Nigeria, I mean, that's one constant, I think, in the oil markets, is that this constant political and who knows what's going to happen in some of these well, let's call it what they are, shithole countries. So we don't, you know, anything can happen. So I think the fix was in, and I think that we were going to see a lot of these players backing off on their production because they don't want to get into an oversupplied market. They're gun shy on that, and they actually control the market. They can control the market, and I think you're going to see that happening over the next couple months. So what has really changed? Nothing. I mean, fears of, you know, the oil markets are very susceptible to sentiment. They fly on sentiment. If you have something, you know, violence breaking out in Libya or Nigeria, that can affect the oil price. The sentiment changes very rapidly, and it has a big effect on the price. So I think, you know, one of the things that we're hearing now is a new narrative developing of a worldwide slowdown. The U.S. is slowing down. Therefore, economic growth will slow down or possibly even go negative, and energy demand will also decrease. Not sure if that's accurate. I saw a chart this week that Chinese oil demand was at an all-time high. I also read an article, maybe I'll put a link to it because it's kind of interesting. It just talks about how travel inside India, the middle class in India, I mean, the air travel, how it's just exploding. I mean, and that's product demand, kerosene and jet fuel for all these planes, and it's the things that we take for granted. You know, I'm flying back from Chicago yesterday on Southwest, and just seeing, you know, how, you know, all these people take for granted they can just fly between these cities. You can be, you know, in a city like Chicago where it was 33 and snowing when I left, and I'm now down in South Texas walking around in shorts, you know, for $150. And that's happening now. The middle classes around the world are now getting to a sufficient income levels where they can begin enjoying that. That's constant demand pressure on oil. And you're not gonna replace ship travel, train travel, goods movement, heavy construction, air travel with renewables. It's not going to happen. So oil demand's not going away. It's going to continue to grow at 1 million to 1.5 million barrels a day, unless we have some kind of worldwide psychotic break like we had in 2008, or like in the, you know, worldwide depression in the 30s. And I don't see anybody really forecasting that. Yes, there could be a slowdown, but you know, people still have to go to work. Most people keep working. Most people keep doing what they need to do, and oil demand does not shrink that much. Even in 2008, it was down slightly. It wasn't like this huge, like 20% drop in oil demand. And that's one of the things I put up here. You know, the IEA consistently underestimates demand growth, and they've constantly have to revise upward demand growth. You know, it's not just China and India. It's, you know, places like people don't even think about. You know, India, Vietnam, you know, Cambodia, all these places, you know, are, you know, have populations, and the economies are growing. And anytime the economies are growing, they require more energy input, and oil is the one of the biggest energy inputs into any economy. So, you know, another thing I wanted to point out, you know, in the last week when the oil prices collapsed, basically, has investment in new reserves and production increased to cause a glut? No, nothing's changed. I mean, projects aren't getting sanctioned, and the longer that these oil prices stay down, and the refusal or inability or just not wanting to, or shift in focus to shareholder returns instead of investing in new reserves and production, eventually that's going to come back at some point in the future and cause a oil spike. It's just going to happen. We do not have enough reserves found to deal with the relentless demand increases and increases in depletion that are relentless. I just pointed out in the previous slide, major producers now pumping at maximum. There's no spare capacity. So if anything happens, you could get an oil spike. All the major producers are producing at 100%. Expect discussions on production cuts. OPEC and Russia are self-interested actors and want to maximize their returns. And this is for various reasons. I mean, in Saudi Arabia, they have a very fast-growing population. They need to do something to deal with all of these young people, young men especially, and how are they going to keep them employed and keep them from overthrowing the government. So they need to maximize their returns. Same thing in Russia. I mean, Russia's not only a big component of their economy, but it's also a geopolitical tool for them to stay relevant. So it's certainly not in the interest of these folks to see the oil price go down to $50, $40, or $30 a barrel. I'm not saying it can't happen. I'm not saying we're not going to have a worldwide depression. I don't know. I'm not a soothsayer. I am not a fortune teller. Anything can happen. But what we have to do is operate on what's most likely to happen. And what's most likely to happen is a slight slowdown in growth around the world. And, you know, these countries enter recessions and then they come out of recessions. They don't just stay permanently in recessions. So even when this is happening, we're still seeing oil demand growth. And the simple fact of the matter is there is not enough investment in new oil. At some point in the future, this is going to be a big problem. Financial demand for oil has fallen. As we're talking about the futures contracts, I showed you in that chart how waterfall dropped. And like we said, we can expect more volatility. Now that's going to work. That volatility will work for us on the upside also, guys. Once the sentiment changes again and the trend changes, you'll see the computers click in and be buying, and it'll be the same thing. You know, the sentiment will change, and you'll have some moron on CNBC explaining it. I mean, I don't sit here and try to explain day-to-day price fluctuations in the oil market. It's stupid. I mean, the fundamentals that I am looking at have not changed around demand and supply. So that's the thesis. I'm not going to sit here and sugarcoat it. A lot of the oil stocks, related stocks in my portfolio and in your portfolios, I'm sure, have been just, you know, taken out to the woodshed and beaten. But if you have analyzed this correctly and you think that, you know, the factors that I've put in place are what's really happened, then there's tremendous value out there. You have basically, especially like in Canadian exploration and production and in service companies, basically selling at depression-like levels. No one wants to deal with Canada. They have pipeline constraints. It's all negative sentiment. I mean, it is the worst I've ever seen. Here, you know, in the U.S., same thing. We've seen a lot of our offshore service companies taken out to the woodshed, but yet I see them report, you know, they're healing up on some of their earnings reports. So things are getting better. And at some point, major oil companies and national oil companies that actually produce most of the oil in the world, they're going to have to seek to replace reserves and production. So that's my view. That's one man's view. I'm not saying that's the best view or the correct view. That's my analysis. If you want to hit me up in the comments section, I'm happy to have a discussion about it. Point out where I'm wrong. But I like to deal on facts. You know, what's real demand, what's real supply, what's really changed. If your opinion is well, we're going to have an economic slowdown in the oil price. Well, no one knows if we're going to have an economic slowdown. I mean, LEIs in the U.S. are still high. I mean, all the data is looking good right now. And like I said, even though China's slowing down in the trade war, demand for oil was at an all-time high last month. So I'm not sure. Let's deal in facts, not just what we want to happen or we think is going to happen. And that's one of the things I want to, you know, I got to be careful of too. I don't want to get in this thing as well. I have this view that lack of investment is going to cause oil production to decrease, and we're going to have an oil price spike, and then just stick to that as the price collapses. But you know, if you know, I want to be like John Maynard Keynes said when he was asked why he changed his view on something. He said, "When the facts change, I change my view. What do you do, sir?" I discount the rest of his economic theories, but that statement is absolutely correct. So That's it for this week. It was kind of a longer video. I hope I didn't put you to sleep. Appreciate the comments. Thank you for watching. The channel continues to grow. Keep hitting that subscribe button, guys. It's really helping out. And you know, if you're interested in understanding how I'm taking advantage of some of these things, or specific companies I think that are going to take advantage, then please consider taking a subscription to the Actionable Intelligence Alert. Again, thank you for my Patreon supporters. Appreciate you guys. If you want to support me that way, you can. Patreon is the way that you can make a small contribution each month. It helps support my work, and because there is, you know, I do have expenses here doing these things, and it's helpful. If you subscribe for $5 per month, or I will give you the current month's, just the current month's stock pick from the Actionable Intelligence Alert. It's not a subscription to the newsletter. It's one pick, the most current pick from the newsletter, so that you can get a sampling of what kind of work I'm doing, and how the writing is, and what kind of stocks we're looking at. So if you want to try that out, you can. So again, guys, appreciate the support, and thanks for listening. We'll talk to you next week.